Most people think investing is something you do after you pay taxes. However, the wealthy do it in reverse. They invest to stop paying taxes. Before we list the assets, you need to understand the math. Your tax is based on your taxable income. If you earn $100,000 and do nothing, you pay tax on $100,000. However, if you take $20,000 and move it into a tax-deductible investment, the IRS pretends you only earned $80,000. If you are in a 22% bracket, that single move just saved you $4,400 instantly. And if you are in a higher bracket, like 37%, that same move saves you $7,400. The more you earn, the more valuable these investments become. I am your host at the All Bookkeeping and Taxes channel. A very warm welcome to you. Friends, today we are going deep. We are covering 8 specific investments that the IRS literally pays you to own. Grab a notepad because we are going to save you a lot of money. Let's start with the accounts you can open today. Asset number 1, the traditional IRA. This is the easiest place to start. You can open this at Fidelity or Vanguard for free. For 2026, you can contribute up to $7,000 or $8,000 if you are over 50. But here is the warning. If you also have a retirement plan at work, this deduction might disappear if your income is too high. So check your limits first. Asset number 2, the traditional 401k. This is the big brother. The limits here are massive, over $23,000 for employees. If you have a business, you can even set up a solo 401k, which lets you contribute as both the employee and the employer, potentially sheltering over $70,000. Asset number 3, the health savings account, HSA. I love this one because it has a special rule. With an IRA, you pay taxes when you retire. With an HSA, if you use the money for medical costs, dentist, doctor, massages, you never pay taxes on it. Not now, not later. Now, this one is tricky, so pay attention. Asset number 4, donor-advised funds. Many of you give to charity, but if you just give cash, you might not get a tax benefit because of something called the standard deduction. Most people claim the standard deduction because it's easier, but a donor-advised fund lets you bunch your donations. You can put a huge amount, say $50,000 into the fund in 1 year. This pushes you over the limit, so you get to itemize and take a massive tax write-off immediately. Then you can slowly give that money to churches or charities over the next 10 years. Asset number 5, a small business. This is the most powerful tool in the code. If you are an employee, you pay taxes on your gross income. If you are a business owner, you pay taxes on your net income. That means your internet, your phone, your travel, and your startup costs are deducted before the IRS calculates your bill. You are buying things you need anyway, but now they are tax deductible. Now, let's talk about real estate. There is a huge confusion between short-term and long-term rentals. Let's clear it up. Asset number 6, short-term rentals. The IRS has a specific rule. If the average guest stays for 7 days or less, like an Airbnb, this is considered a business activity. Why does this matter? Because business losses can offset your W-2 salary. You can buy a property, use depreciation to show a paper loss, and use that loss to lower the taxes on your day job. Asset number 7, long-term rentals. These are different. Income here is passive. And the rule is passive losses can only offset passive income. If your rental shows a loss, you generally can't use it to lower your salary tax. Unless you are a real estate professional. To qualify, you need to spend 750 hours a year managing real estate. That's about 15 hours a week. If you don't have that time, stick to short-term rentals for tax benefits. Asset number 8, oil and gas. I am not talking about buying Exxon stock on Robinhood. I am talking about investing in private drilling partnerships. The US government wants energy independence. So if you invest in drilling, they let you write off 65% to 85% of your investment in the very first year. This doesn't require you to be an expert oil man. It's a passive investment with active tax benefits. But you usually need to be an accredited investor to get in. So, what did we learn? Tax planning isn't just about filing forms in April. It is about where you put your money in January. Whether you start a solo 401k, buy a short-term rental, or just open an HSA, you need a plan. At All Bookkeeping and Taxes, we don't just record history, we help you write it. We review and quote free of cost. If this video helped you understand how smart investments can legally reduce your taxes, please like, comment, and share it. And don't forget to subscribe to our channel for more practical tax saving and money planning strategies. Thank you for watching.